Alright, what's going on, guys? Today's Monday. I'm going to get this news out quick before I actually go out, take a walk around the neighborhood. But anyway, let's go to the news today. So today, we have to talk about how the stocks are having a better future. Okay, so right now, we are looking at stocks future. Rise following S&P 500 was weak since March of 2020. So basically, if you have not watched the video that I posted on Saturday about how the market is doomed, you can just go to my channel and find the second latest video. It should be up there. But anyway, we actually got the worst week in the stocks market since the pandemic started, which was in March of 2020. That was essentially what we call the peak of panic fear during that period of time, because no one knew what this whole pandemic is going to bring about. And that's why the fear was technically at its maximum, and then people basically just sold out everything. So right now, we're actually similarly around the same area as well. We actually had one of the worst weeks since the pandemic actually started. Nasdaq was down about 12%. S&P down about, if I'm not mistaken, 13%. Dow was down about like 9%. And this all happened in 1 week. So if you do trade in the market, you know that usually for them to actually move anywhere north of 2% in a week, usually this is like considered big news. And for them to suddenly see it 12% on Nasdaq, 13% on S&P and such, was quite bad. But yeah, basically because of that, right now we are actually having a slightly better futures because people are starting to use the weekend to kind of rethink their investment strategy and think like, are we really that worried about the market? One question that actually comes to mind is what actually changed? What fundamentally changed in the week prior to the point where people feel that, all right, we're going to sell off. All right, we are not going to be holding on to our long-term stocks. We're not going to be holding on to our FANG. We're not going to be holding on to our long-term deep value growth stock and such. So it kind of bring about this kind of questioning for a lot of people who are invested in the market. So first of all, for people who do not know, one of the reason I feel fundamentally changes is because of Netflix earning. So for people who do not know what FANG is, which is the FAANG, they actually include Facebook, Apple, Amazon, Netflix, and Google. Okay, so basically these are the five ticker symbol, basically the biggest American tech company of its time. Well, still as of now as well. And because if Netflix basically came out to report, well, it's not bad earnings, it was just bad forecasts. And because of the bad forecast, it kind of foreshadowed the possibility that, Apple, Amazon, Google, all of them, they're going to be having bad quarters moving forward. And that's kind of worry that we are actually having in the market right now. And even for Amazon, Amazon was also having the worst week. So over here, Amazon stock had its worst week since 2018. And, mind you, 2018, okay, do understand that this is not even since March 2020. This is since 2018. This was a good 4 years ago since Amazon actually had such a bad week. And basically, this is kind of, to some extent, kind of expected from my side as well. Even when I made my prediction video for 2022, I talk about Amazon as well. I feel that Amazon don't really have any sort of huge disruptive innovation left in the company. Because right now they are at such a huge scale to the point where it's very hard for them to actually innovate for something newer. And because of that, I can see why Amazon kind of will sideways trend and even go downwards for 2022, which is why I feel them having a stock split is very, very, very important, because I can see a lot of people wanting to get into Amazon, but because the barrier of entry is way too high for retail investors like you and I to really get into Amazon, and because of that, I feel that it becomes very tough for Amazon to really get that huge retail hype from all the retail investors. So right now, basically, just your hedge fund, your institutional investors, they are the one that's really partaking in the Amazon run. And yeah, because the shares of Amazon fell 12% for the week. And the worst 1 week performance in 4 years since December 21st, 2018, where the shares fell 13.4%. Yeah, so that's why I think the main reason why I feel the only fundamental change, personally, I would say that it will only be because of the forecast by Netflix. I think that would be a huge catalyst for people to fear where the fundamentals actually change. Because if the Netflix come out to say that the forecast for the year-over-year growth is going to be dropping down to 10%, their subscriber count, they are actually forecasting it to drop more than 52%. Basically, this kind of set the tone for Apple for their products. Honestly, I think Apple might not have that big of an issue. I think Google might have a bigger issue because Google is on the side of ad revenue. I think Facebook is going to have an issue because Facebook is also on the side of ad revenue, and also because I'm not sure what Facebook really want to delve into, especially what Zucks is trying to do. Because I think Zucks is really trying to go bullish on the metaverse, explaining the whole entire Meta platform's name change. So I'm not sure how the cash burn will be like for Meta platforms in the near future. But I think that's one of the big reason why people are technically selling off your trillion cappers, basically because of Netflix alone. So over here you can kind of see, basically Netflix is one of the most important issues here. And also for people who do not who feels that this is technically because of the Federal Reserve increasing their rate hikes. We already knew that the rate hike is going to happen before the prior week even happened. So I don't think that would be a fear catalyst that we want to bring into this for the biggest sell-off that we had. Of course, a lot of people probably want to put that into context and be like, yeah, because there is a possibility that they might want to raise their rates a few more times, but nothing has changed to the point where, because it's not as if we have an FOMC meeting where Jerome Powell came out to say, all right, we are going to be raising rates 5 times instead of 3 times, or there's going to be a economic projection saying that our inflation is going to be 3.2% instead of 2.5%, and things of that nature. Right now, it's basically just no substantial evidence saying that what will be happening in the market, but everyone just kind of are just very, very scared, especially after the Netflix. I think the Peloton news probably did shake the market, especially for the smaller caps company. But I don't think it's gonna be one of the bigger catalysts for the trillion cappers. I think the Netflix one really did shake a lot of the companies, especially because right now we're in the earnings seasons as well, which is why I think all eyes are going to be on the earnings season to come. Okay. Anyway, let's not get too hungover by this. Let's look at so shifts within the bond market are removing a key pillar of support for the Wall Street more speculative bets, dragging now major stock indexes as investors flee everything from tech stock to cryptocurrency. All right, so for people who do not know cryptocurrency, just a check for you guys right now. Bitcoin is doing at $35,236. Ethereum is doing 2.412. Let's look at the rest. Dogecoin is doing 13.6 cents. Cardano doing at $1.04. Shiba Inu is 0.00021. Solana, do I have Solana up here? Solana at $87.50. Polygon at $1.46. Polkadot at $17.38. XRP at 60 cents. Terra Luna at $63, and Decentraland at $1.97. So yeah, basically, from all these numbers that you hear on cryptocurrency, you can basically tell crypto basically fell a good 20% in the last 3 days, 20 to 30 20 to 30% in the last 3 days. And if we are taking from the all-time high, just taking Bitcoin for example, we are already down 50% from the all-time high, which is $69,000. We're down to about 35,000 now, so that's around 50%. For the other alts, we're looking at 60 to even 80% for some. So yeah, the market is spooked, okay? Spooked in large part by raising bond yields. Investors continue to dump stocks last week, extending early year losses that may have taken many off guard with the speed and severity. I think this is just an article basically explaining what I already explained in the video, so nothing really interesting for that. Activist investor call on Peloton to fire its CEO. Okay, that's interesting, I guess. Yeah, after the CEO, okay. Honestly, I feel that this is kind of unfair as well, because the CEO basically brought the stock all the way to $120. Just because it's kind of fallen all the way down, people want to fire the CEO. And pursue a sale. Once a pandemic darling, a homebound customer ordered its exercise equipment that pairs with virtual classes, which is kind of funny because Peloton was still saying that, like, we are going to be separating the prices for the bikes. So if you want someone to help you do the installation, it's going to be an additional charge as well, which I think was very, very bad move by Peloton. You could simply just give a free installation. You want people want incentive, and at that point of time, the demand wasn't that high. I don't know what Peloton was really thinking of. So, let's see. The Foley said in a subsequent letter to employee that Peloton is reviewing the size of its workforce. Yeah, blah blah blah. Yeah, I mean, this was basically the news that we actually covered on the Peloton as it is. I think it's just them wanting to fire the CEO. Nothing really special about it. Anti-ARK ETF amasses $234 million as Cathie Wood falters. Okay, this one they actually talk about S-ARK, which is by Tuttle. Yeah, so I knew about this S-ARK because basically how it works is that they are not really shorting Cathie Wood Fund, but they are doing a swap on the Cathie Wood Fund. It's a different sort of financial instrument. So I wouldn't exactly call this shorting the market. It's just a swap-ish kind of thing. So yeah, they are just talking about how this ETF basically went, sky high because Cathie Wood isn't exactly having the best year. So I think this kind of brings us back to the point where how people always talk about how Cathie Wood was named this genius in 2021 for having such a good ETF. How she can be so forward-looking, thinking that all right, Tesla is going to go to the moon, Peloton is going to do well, Zoom is going to do well, because all these are so-called disruptive companies. And Cathie Wood was this genius in 2020, especially in 2021, when we started to see all these gains on her ETF. And suddenly, out of nowhere, well, not really suddenly, but like right now, we see Cathie's ETF, be it your ARK-K, your ARK-G, your ARK-F, whatever ARK it is, they're all down. Okay, and Cathie Wood sold out so much Tesla in the past 2 months that she actually sold more Tesla than she actually owns now. And yeah, basically people are just saying that Cathie Wood is a hoax, she's a scam, she don't really know what she's doing. And honestly speaking, I don't really have that much opinion on Cathie Wood per se. I follow a lot of her trades. I follow a lot of her calls and such. But I only follow them. I do not really just buy into it blindly either, because I'm not really very bullish on stocks like your Zoom technology. I wasn't very on like Roku, on Teladoc, on DraftKings. All this basically, I know about all these names because I just like to research on these kind of companies. But for Cathie Wood to kind of screw up her entire portfolio, especially on a grand scale of things, because she had so many ETFs and all of them are basically losing money. People are now basically just coming out and say, oh, okay, you know what? Enough is enough. We're not going to be following Cathie Wood and such. And even Cathie Wood is still coming out to say, I don't think a recession is coming soon. I think that we're still going to be buying into all these deep value companies, which I don't fault her, because the thing is that right now, with the market continuously dipping, it doesn't make sense for them to suddenly stop buying the dip. Personally, I would have already stopped buying the dip. The moment I bought 3 dips, I realized that this dip, the depth of this dip is too deep for me to buy the dip. That's a mouthful. But yeah, because of that, I think that, I'm not sure what Cathie was going to be doing in the near future either. But I think, I think she's going to be losing a lot of support. But personally speaking, I feel that Cathie is still a very, very bullish investor. She, if I'm not mistaken, the last interview that I actually saw of her, she basically was saying something along the line of that we're definitely not in a bubble. We're so far away from a bubble that it's actually crazy, something along that line. And of course, I do think that to a certain extent, I can actually see why she thinks that way, because her whole basis of this thesis is basically just, if we are going into a bubble, the chances are people do not know we are going into a bubble. That's kind of her thesis around it. And because if everyone is so worried about a bubble, it's probably not a bubble because everyone's just cautious enough. I can see it from both sides of things. One is basically just because we have a lot more reckless investors in the market right now as compared to back then. So right now, basically, anyone and everyone is investing, and everyone and anyone is calling it a bubble. So just because we call it a bubble doesn't mean we're not going to be investing in it. So that's my worry. So, and even Elon Musk said that it's going to be a recession. So right now we have this weird spectrum of things. On the right side, we have Elon Musk thinking that we are going on a recession, and on the left side we have Cathie Wood thinking that we are so far away from a recession. I would say I'm closer to Cathie's side of things, but I'm still somewhere in the middle, because at the end of the day, personally, I do not want a recession. And I don't see a recession because although a lot of money is currently being melted and evaporated from the market, but these are all the so-called funny money that we had back in 2020 and even 2021, where all the government, all the stimulus keep on pumping money into the economy. And right now, all this money are just slowly taking its time to evaporate from the market. And I think that's completely fine with that. But what I feel is that there's still enough so-called funny money in the system for us to actually continue on this trajectory to have a healthy economy. Of course, it's not going to be happening in 2022, without doubt. I feel 2024, 2025, there is a good chance. I feel that it would be easier for us to basically just take into account that 2020 was basically the financial depression, the whole financial meltdown in 08. I feel that if we actually just take the March of 2020 as the start of that, it'll be a lot easier for us, so that you can kind of just see how the entire market moved on from there, and it'll be a lot easier for us to do so. Yeah, and basically that's kind of how I'm looking at it right now. Okay, yeah, but basically that's all for ARK. Telecom earnings are coming. What to expect from AT&T, Verizon, and Comcast. Okay, so for this one, I think it's a lot interesting for AT&T, especially because AT&T has been this so-called a home brand. Okay, if people are talking about dividend stock, AT&T is going to be there without doubt. Okay, and right now we are looking at AT&T's earning, because at the same time we also want to look at the forecast. If AT&T's earning and forecast fails us, and especially in the investors shareholder letters, if they actually talk about cutting their dividend rate again, we can see AT&T go down. And AT&T can easily be the trigger catalyst for all the other all the other telecom stocks to go down, be it your Horizon, be it your Comcast and such. Also, at the same time, I feel that this might also trigger a catalyst around all your dividend stocks. So, be it your cleaning supplies, Clorox. Yeah, I'm pretty sure Clorox is a good dividend company as well. Coca-Cola. Yeah, all these kind of weird companies that are kind of out of date. All these companies are also possibly going to be going down if this sudden crash catalyst kind of creates this sort of domino effect for everyone to kind of fall. So I think all eyes are going to be on this AT&T earnings on the 26th. Basically, we just want to see what will the shareholder letters be talking about. And also, speaking of 26, probably I'll just keep this as the last news, technically, which would be our FOMC meeting is going to be on the 25th and 26th. So chances are on the 26th or on the 27th, we'll be getting the Jerome Powell's testimony on it. And that will also be the time where we actually hear about what will happen. So I think this will be one of the biggest catalysts that we'll be seeing in the very near future. We'll see if Jerome Powell intends to raise rates before we even finish tapering. That's the worst case scenario. The base case scenario will just be like, oh, okay, nothing's going on. We're still in the midst of tapering. Nothing's going to happen. And the best case scenario is that they are still going to be saying that, okay, we're still tapering. We're not going to be raising rates until a certain date. For example, April or May or June, whatever it is, we want to hear a date. That will be the best case scenario. But of course, this date, the further away it is, the better it is. Because right now, the fear in the market is that if we get 4 rate hikes, if we get 5 rate hikes, if we get 8 rate hikes, okay? If Jerome Powell comes up to say that we are not going to be raising rates before we finish the taper, basically this 8 rate hikes, this issue is going to be out the ass immediately. But then if the rate hikes is going to be announced on the May or the June, right now, the leftover period of time in the entire year, which should just be 6 months, which would only equate to, say, about 3 or 4 more rate hikes. This means that the high chance of us having a rate hike every single FOMC onwards will only be kept at from the whole May period to December period, which is what we want. So that at least we know for a fact that from January all the way to whenever they are gonna increase the rates, we are gonna have a happy time where people can still get into their real estate, people can get into their stocks, people can get into bonds, whatever it is. Rates are still going to be low. People can quickly utilize this period of time to get into the investment that they want. Kind of like a little bit of a time extension for us to continue to play with the cheap market. And then, of course, the bell will ring eventually, and then we'll have to kind of fight the entire whole May to December fight with the ever increasing interest rates. But yeah, basically, that's kind of my worst case scenario, base case scenario, and also best case scenario for the FOMC meeting at least. And of course, for the next upcoming key event would also be the CPI reading for January, where we actually will be looking at how January actually worked. Is the supply chain actually softening up? Used cars, energy, all this, are they actually going down? I highly doubt it. I don't think we're going to have any sort of deflation or even disinflation. If anything, I feel that we might even see something that will even gradually go even higher, maybe a 0.6, 0.7% or so. So I'm not super duper hopeful for the CPI, but let's take one thing at a time. We're going to go through the FOMC first, then we'll see how it goes. All right, but anyway, that's kind of all I have for today. Tomorrow would be the 25th. Yeah. So that's going to be the start of the FOMC meeting. But yeah, anyway, I'll see you guys tomorrow. Thank you for watching.